Hello, everyone. It's time for Swim with Jim. And we're glad today to have Rick Ferri, the renowned author, investor, money manager, market commentator, and blogger. Rick, welcome aboard.
Thank you, Jim. Thanks for having me as your first guest on this new platform.
Yes, we're really pleased to have you on the video episode of Swim with Jim. And let's start talking about a new kind of investing that's come about the last few years, and it's referred to as Robo Advisors. Can you explain to our audience what are Robo Advisors and how they got started?
Okay, let me explain first what they are, and then I will explain how they got started. Because I don't think that the story on how they got started is really known in many ways. And the people who really got started them were not really given credit 20 years ago when they started the robo advising. But robo advisors is pretty much almost a hands-off way to invest, where you go online, and it's always done over the internet, and you have a questionnaire, very simple, maybe 5 questions to 10 questions that you answer online, and it gives you a profile of the type of investor you are. Maybe you're aggressive, a conservative, and then it recommends a portfolio of mutual funds for you, and most of the time they're very low cost index funds, and the type of structure they use are called exchange traded funds, which we can talk about later if you like. But then it recommends a portfolio for you of maybe 5 to 10 of these funds. And if you decide that you want to invest in this portfolio, you can do everything right there online. You can invest in these funds directly through that website. And the nice thing about it, the thing that makes them robo, when you put more money in or take money out, or the balance between stocks and bonds gets out of whack, the algorithm automatically brings the portfolio back to your level of risk, or that level that you want it to be at. So it's automatic. So robo investing is really automatic investing in a portfolio, automatic rebalancing, and also automatic tax loss harvesting, where if things go down in value, things will be automatically sold so you can harvest tax losses. That's part one. I can get into part two as to where this got started, if you'd like. And that is that 20 years ago, maybe even 20 years ago, it started in the mutual fund industry. Mutual fund companies had you go online, fill out a questionnaire, come up with your risk tolerance level, and then instead of a group of mutual funds, they had you select a particular balanced fund, meaning it was just one mutual fund that had a mix between stocks and bonds based on your particular level of risk. And the mutual fund did all of this rebalancing as you put money in. And I always felt that that was the beginning of robo investing. But with the independent robo investing firms, kind of even more complex than what it used to be. And I'm not sure if it's better, but to me, robo investing started 20 years ago with the mutual fund industry and using balanced funds to do the same thing.
So what are some of the advantages or disadvantages of investing in with a robo advisor?
Well, the advantage is it's cool because you're using the internet and you think you have something that is, designed especially for you, but really you're not. Another advantage of the robos is they're probably better at tax loss harvesting, where they're able to, if it's a taxable account, where you can actually use tax losses if the market goes down. So a robo would be better there. But if it's an IRA account or a tax sheltered account, it doesn't make any difference. What are the other advantages? That would be about it. The disadvantages of using a robo are that, number one, you have to pay a fee for it. I mean, they're not free. You shouldn't say not all of them. There are some that are free, but you have to pay in other ways. In other words, Schwab has a free robo program that uses a lot of Schwab mutual funds and puts a lot of your money in the Schwab bank account, where he ended up, the fees are quite high there. So, I mean, they get their money one way or another. Again, if you were just going to use a balanced fund, it's probably a lot less expensive than using a robo. But, robos are cool. People are talking about them. We're talking about them. They're using exchange-traded funds, which, even though exchange-traded funds have been around for almost 25 years now, they have become cool in the last few years. So, sort of the chic thing to do at the moment.
So I have seen some talk in the industry about some of the bigger players buying up those robo advisors because they're starting to gather a lot of money that might have been initially going to a wirehouse like Merrill Lynch or to an insurance company like Mass Mutual. Can you speak to that issue of what trends that you're observing that these, we'll call them startup robo advisors, might be enveloped by the bigger players?
Sure. So the bigger players are looking at the technology that these companies have developed, and they're buying the technology. I don't think they're really buying the assets. These companies are technology companies that happen to have decided to get into the investment industry. If you look at the backgrounds on most of the people who are creating these robo firms, they're Silicon Valley backgrounds. They worked at LinkedIn before they started working on robo advising. So they're technology people mostly who have decided that they're going to use their expertise in software engineering to create technology for the financial service called fintech. And this is what the big companies are buying. They're not buying books of business. They're not buying the assets that these companies are collecting. They're buying the technology to reduce their own costs internally and to deliver products and services that it might cost them a whole lot more money to just develop themselves. So that's what's going on there. So you might see a lot of companies now who don't have really much assets under management at all, but a large company, State Street, or a large insurance company or a brokerage firm would buy this company up because they want the technology, and that's fine, and that happens all the time in every industry. So that's what's going on. The big robos, the ones that have actually collected assets, such as Betterment, who's collected over $5 billion, and Wealthfront, who has collected over $4 billion. From a financial standpoint, those companies have spent hundreds of millions of dollars to bring in $5 billion in assets, which, if you look at their fees, maybe will generate $10 million a year in fees. So it's just not profitable from that perspective to go out and buy one of these. But the bigger ones like Betterment that have collected $5 billion and are earning maybe $10 million in revenue, they have, I think, venture capital money of at least $150 million. Well, they're not going to be profitable for a long, long, long time. So that's not why you would buy one of these companies. You buy it for the technology because you think it fits into the rest of your platform that you're creating.
Would Schwab be a good example that you mentioned earlier of a big company just coming up with their own technology or somebody else's technology to gather assets?
Yeah, so Schwab's reasoning behind creating a robo, whether they went out and bought one or they actually ended up creating their own technology, was that they wanted to be able to channel through this technology their own mutual funds and their own money market funds. So you go to Schwab, they introduce the idea of using their Schwab Intelligent Portfolio. You take the questionnaire, you look at the recommended portfolio, and guess what? They're all Schwab funds, or most of them are Schwab funds. So, I mean, it's a way for them to distribute, another way for them to distribute their own mutual fund products and their money market. So that's so they had to have they wanted the technology. The question was whether they were going to build it in-house, whether they had the resources to do that, or whether they were just going to go out and buy something on the street. And that's just a decision that these large companies are making, whether to buy or build. And but they're all getting into the technology to be able to do this rebalancing, automatic investing.
So in the time we have left, as I understand it, in my philosophy is that you've got do-it-yourself investing, where you can buy mutual funds or index funds and do it yourself, to the other end of the spectrum where you hire somebody for 1% or 0.5% or whatever to have them manage the money for you.
Mm-hmm.
Are robo advisors fitting in the middle between those two, or are they on a different paradigm?
That's a good question. Are they fitting in the middle between those two? I think that may be accurate, because you were saying that most of the average fee to have a money manager is maybe 1%. It's coming down, but let's say 1%. A lot of people won't pay that. But 0.15 to 0.25 to be able to have a money manager, or at least the belief that somebody is looking over your portfolio, some people would probably pay that, as opposed to going and buying a balanced fund at a fund company. Other people would do that. Now, the do-it-yourself investors who are going to create their own portfolio, a lot of people might be uncomfortable doing that. So if they're uncomfortable doing that, they can either buy a balanced mutual fund that does it for them within one fund, or they could do one of the robo programs, and it's relatively inexpensive. And then there are lower cost money managers too that you could find out there as well.
Well, great. Rick, thank you very much for your perspective on robo advisors and where they might fit in with today's investors. I'll put down in the comments section a link to NerdWallet. Full disclosure, I'm one of the writers on and answer questions on Ask an Advisor on NerdWallet. And they did a study earlier this year on robo advisors and rank ordered them. It's just one person's opinion on how they fit in, but I think it's good for people to look at that. The other thing is, I should have full disclosure that I have been a customer of Betterment for over 4 years. Mm-hmm. So when it first popped up on the horizon, I thought, well, I think I'll give them $100 a month and see what they can do. And I now have close to $5,000 with them. And they do tax loss harvesting, and I get an email every few weeks on the dividends that are going back into the portfolio. So it's an interesting hobby to see what they do. But as you might suspect, I'm a do-it-yourself investor.
Well, let me ask you, Jim, how long have you been with Betterment? 4 years?
Yeah, about a little over 4 years.
And you have $5,000?
Yes.
And you put $100 a month in. So that means you put in $1,200 a year times 4 years would be $5,000.
Right.
So
well, I'm not telling you the exact numbers or the exact time, but it seems to me that my profit is close to $500. So,
and that, a bull market raises all boats. So I mean, it's fine. I mean, believe me, I think that if that gets you to invest in a systematic way where you're not going to go around and do other things, you're just going to do that just like you described, and you're just not going to mess with your portfolio. That's good, because the thing that really brings a portfolio down is people messing with it and trying to do market timing or trying to find funds that are going to outperform. So if doing a robo stops you from doing that, then by all means do a robo.
Rick, thank you very much. We really appreciate the time you spent with us today. And tune in soon, at least once a month, for Swim with Jim in a video version. Bye for now, everybody.